Thank you for joining us today. The time is 10 o'clock. Let's begin. First things first, a disclaimer. The information that we are going to discuss today is current as of today's date and is for informational purposes only. It is not intended to address the specific needs of any individual, and it also does not serve as investment, taxation, or legal advice. The products and services discussed in this webinar, if any, do not constitute an offer to sell or a solicitation in connection with any products or service. The topic of today's webinar is retirement. As always, we will do some self-introduction first. I am Shirley Nelson. I am Chinese. My Chinese name is Mei Shihui. I had my undergraduate degree in engineering from NUS. I subsequently completed a Juris Doctor degree from Case Western Reserve University in Cleveland, Ohio. I am currently an associate advisor at JGUA. If you'd like to reach out to me, my email is on the screen. My area of focus is investment, taxation, and insurance review. So I speak and write English and Mandarin Chinese. I'm a licensed attorney with inactive status, which means I'm not currently practicing law. I'm also a registered patent attorney with USPTO. In the area of finance, I have passed the CFA, level 1, and then I intended to complete the upper levels in the coming years. I'm going to turn off my camera soon, so hopefully you will have a larger screen area to watch the slides presentation for today. But before I do so, I'd like to proudly introduce to you all my colleague, Amanda.
Thanks, Shirley. So hi, everyone. My name is Amanda Herrick-Smith, and I'm a senior advisor here at John Allman & Associates with 14 years of experience. And some of my specialty areas include education planning, both saving and student loan paydown strategies, estate planning, retirement planning, and tax planning and preparation. So at John Allman & Associates, we have the privilege of serving clients since 1978, which is actually 42 years this month. When we begin a relationship with our clients, we help by actively managing a minimum of $250,000. We work with entire families, helping our clients, their parents, as well as our clients' children. So not only do we provide financial management, we also provide financial planning services. And some of the service areas include tax planning and preparation. We have a separate tax department with CPAs and enrolled agents for the exclusive use of our clients. And although we do not practice law, we do help our clients review or begin their estate plans. We also help with retirement planning to assist with answering the tough questions such as, do I have enough money to retire? We also help our clients as they enter different chapters of their lives, such as when they change jobs. We help to analyze compensation packages or stock options, or when they get married, buy their first home, or have their first child. Also, we understand the importance of our clients to protect their hard-earned assets. Just like we do not practice law, however, help with estate planning. We also do not sell insurance products, however, help to review their insurances to be sure they are properly protected. And in the challenging time many are facing with salary reductions and possible loss of employment, we are there for our clients every step of the way. So this is the last webinar of our 4-part series exclusively for CCA members. We have come a very long way. We covered investments, the United States healthcare system, Tax 101, and today we'll be covering retirement.
For today's webinar, we'll be referring to some of the healthcare and tax topics that we discussed before. If they are referred to, it will be brief and serve like a refresher. For those who are new to these topics and think we're moving too fast, let us know, as we'd be happy to explain it in more detail.
So, all right, retirement. So have you heard any of these terms? How about 401k, IRA, stock options? How about RSUs, Social Security, annuity, or wills and trusts? but we will be discussing them during today's webinar. So I'm going to turn off my camera so you can be provided a larger screen to view our presentation slides today. So I'll see you in a little while. So today's presentation on retirement has 3 parts. For part 1, we will be discussing the importance of prioritizing retirement, regardless of your age or career stage you are in. For part 2, we will be walking through a checklist to help answer the question, are you ready to retire? For part 3, we will be discussing ways to preserve your legacy. We will also be featuring 3 question and answer sessions after each section. We will plan to set aside about 5 to 10 minutes for the first 2 questions and answers sections, and we'll answer as many questions you may have during our last questions and answers section. So please feel free to utilize the chat feature to share any questions you have throughout our presentation today.
We anticipate today's webinar will last for about an hour. However, we're dedicated to stay longer if you have further questions. The focus is about you, our audience today, and we're here to help you better prepare for your very own retirement. If you have any questions, don't hesitate. Just typing in the chat box, or even better, unmute your microphone and just ask us.
Exactly. We'd love to hear from you. For the first part, we will be addressing the following topics: employee benefit plans, company stocks, Social Security, and lastly, insurance products.
And I'd like to reiterate that we don't sell any insurance products, but as part of our service, we do help our clients review their insurance contracts. So if you would like an honest review of your policy, or if you're considering getting a specific policy, reach out to us. We'd like to help you review your options.
Okay, let's get started with employee benefits. When it comes to employee benefits, there are usually 2 main categories: qualified plans and non-qualified plans. A qualified plan simply means the plan has attained a qualified status under the Internal Revenue Code Section 401A.
A common reaction when someone hears about 401, he thinks of 401k. Well, there are actually a lot more qualified plans than 401k, right, Amanda?
Right. Among these qualified plans, we typically put them into 2 main groups: pension plans and profit sharing plans. The main difference between these 2 groups is the legal promise of the plan. If the promise is to pay pension at retirement till the participant dies, then it's called a pension plan. If it is simply creates a deferral of compensation and taxation, it is a profit sharing plan.
Within the first group, pension plans, there are also 2 subgroups based on who is bearing the investment risk. Is it employee who bears the risk or employer? When it's employee who bears the risk, investment accounts within the plan are usually separate, so each employee can make her own decision. But don't confuse investment risk bearing with the source of money. For example, for the one where employer bears the risk, such as defined benefit plan and cash balance plans, many of them not only allow, but sometimes require that employees contribute to the plan as well.
Right. For example, in one of the cash balance plan documents I've seen, it stipulates that when an employee is making over the Social Security base limit, they must contribute 2% on the portion of their pay that exceeds that limit.
Interesting. That sounds almost like a mandatory contribution.
Right. Each plan is unique. So even among the qualified plans, the Internal Revenue Code 401 rule only sets the broader framework. Each company has large wiggle room to customize the plans to their liking.
So we've looked at some examples of the pension plans. Before we show you every other plan on the slide, we would like to first introduce some of the common ones that I bet most of you have heard about before. For example, under profit sharing plans, we have 401k.
401k is a contributory plan also known as employee self-reliant plan, meaning it allows employees to defer their salary and contributions to the plan. This feature makes it different from the non-contributory plans where only the employer is allowed to fund the plan.
I guess we can simply put it like this. For non-contributory plans, the employee has no say whatsoever about how much to put into the plan. It's all employer. An employee is not involved in the decision making.
We call the pension plans and profit sharing plans qualified because they all have tax advantage granted by the Internal Revenue Code Section 401. But there are other plans that are non-qualified, but are still given some of the tax advantage by statutes other than IRC 401. We call these the tax advantage non-qualified plans.
The most popular plans under this group are traditional IRAs and Roth IRAs. These plans both have great tax advantages, and personally, Roth is my absolute favorite. We will be discussing the details about them in the next few slides.
Before we do that, we'd like to review all of the plans in the slide. Ready? Here you go.
That's a lot of plans.
Each plan has its own unique quirky rules too.
It would take us days to talk about the details of every one of them, and we will not bore you with all that today. For today's discussion, we'll just be focusing on these three: 401k, traditional IRA, and Roth IRA. And note I highlighted the traditional IRA and Roth IRA in this yellow square. That's because these are the only two of all the plans on the slide that can be independently opened by an individual, whereas every other plan depends on the employer.
If your employer provides some plans on the slide, even if it's a hybrid or variation of some of the plans here, feel free to let us know and be happy to take a look at the plan document for you to help you better understand the benefits that you're entitled to.
Okay, moving on. Tax deferral. We say that plans like 401k offer this tax deferral benefit. Exactly how does it work, Amanda?
Well, it's best understood if we draw a timeline as represented on the slide here. At the present time, we put some of our salary into this 401k account pre-tax, meaning we don't pay income tax on it. This money then grows within the account without incurring any ordinary income tax or capital gain tax during its growth. When it comes to the distribution phase, we pay income tax each year only when we withdraw money from the plan. Shirley, how about a simple example?
Of course. Say I elect to defer $5,000 of my salary to my 401k this year. This amount is directly transferred from my company's payroll system to my 401k brokerage account without me even seeing or touching this money. Let's assume the $5,000 stay invested for the next 30 years. And if we assume an 8% rate of return annually, this $5,000 will grow to about $300,000 by the end of the 30th year. And I haven't paid a single tax on it for the entire 30 years. When it's time for me to withdraw money from this account, and then say I decide to withdraw $20,000 in the 31st year, I only need to pay income tax on that $20,000 for that year. The remainder $280,000 can remain inside to grow tax-free.
Remember that income tax formula we presented last month? This formula can help you see how the tax deferral advantage plan plays out. Your 401k contribution that you elected to defer from your salary shows up here as the above the line deduction. Also deducted here is your elected salary reduction to SEP or simple IRA. If your employer allows these options, your contribution to a traditional IRA can be deducted too if your income is below certain thresholds.
If your employer matches your 401k deferral, the match shows up here as exclusions. Employer contribution to SEP and simple IRA are also going to be excluded. Exclusion is even better than deduction, as the excluded amount is not even subject to Social Security or Medicare taxes.
It therefore makes sense to always find out if your employer matches your 401k contributions. If they do, take it. It's free money. Your contributions to the plan can help to reduce your overall taxable income, thus resulting in less tax you pay.
An other amount that will be excluded here is your payroll HSA deferral. This is a health saving account, and money that goes in is triple tax-free when used to pay for qualified medical expenses, including medical insurance premiums. Even if your employer doesn't provide one, you can create a non-payroll HSA on your own. Just note that a contribution you made to non-payroll HSA is not exclusion, but a deduction. So it will still be subject to Social Security and Medicare taxes, even though not ordinary income tax.
Another benefit we'd like to mention here is dependent care flex spending accounts, or what's known as an FSA. Contributions made to these accounts can be excluded also. If you have a child or an aging senior who is claimed as your dependent, you may want to consider putting some money aside in your dependent care FSA account if your company provides one. This can be used on daycare expenses, after-school programs, and senior daycare and so forth.
The immediate tax benefit of contributing to these plans is reducing your taxable income. Once the exclusion and deduction amounts go up, your AGI, also known as adjusted gross income, goes down.
Additional tax benefit is realized when these contributions start growing inside their plans, tax deferred. When it's time to take a distribution, we throw each distribution into this income tax formula shown here. These distributions are not subject to payroll taxes. They will be subject to ordinary income taxes.
We know from our last webinar's discussion that ordinary income tax is higher than capital gain tax. Is there a way we can make some of these distributions subject to lower capital gain tax, Amanda?
It is possible when you hold your company's stock in your 401k account. You can elect to do a net unrealized appreciation distribution, also known as NUA, with your company's stocks. The gain in value of the stock will be subject to the lower capital gains tax when NUA is elected.
Sounds like there is a lot of tax advantage that we can use. Someone probably will ask, can I choose to defer all my salary into my 401k if I don't need the money now? Unfortunately, there are limitations. For one, we have a compensation limit for defined contribution plans. This caps how much of your salary will be used, say, in the 401k contribution match from your employer. For example, if your employer is matching $1 for every dollar you defer to your 401k, up to 5% of your compensation, and you are making $500,000, your employer will not be matching 5% of your $500,000, but instead only match up to 5% of $285,000. In addition, some employers have strict 401k contribution rule. In example, I have seen a 401k where it stipulates for those high earners, say this one who makes $500,000 a year, when he reaches $285,000 compensation, usually by September, the company will forbid him to make further salary deferrals and also will cease the 401k matching after September.
For deferred benefit pension plans, there's also a limit called the annual benefit limit, which is $230,000. This limit is used to calculate the maximum annual contribution that is made to a deferred benefit pension plan. So your protected future annual benefit from this plan do not exceed $230,000 in today's value. To calculate the present day contribution maximum, a projected rate of return is needed. Usually your plan administrator will tell you what that number is every year.
Highly compensated employees, also known as HCE. If you are making more than $130,000 a year, you are deemed a HCE per statute. Though it's possible your employer could elect to limit HCE to, say, only the top 20% of paid employee per compensation. In either case, if you are making more than 130,000, it's possible you are HCE. Then how much you can contribute to your 401k is no longer up to you, but is limited by those employees who make less than you, specifically how much they elect to contribute to their plans. This can be messy, as oftentimes you won't know how much others are contributing until well into the next year. If you are HCE and you found out next year that you over-contributed for this year, your company could most likely refund you the excess contribution you made. This will count as taxable income, and you might be subject to extra tax liability for this year.
For companies that match employees' contribution, they are likely constructing their 401ks under the IRS Safe Harbor provision. If Safe Harbor is used, the limitation on HCE is lifted. But we all know due to COVID-19 this year, many companies stopped 401k matching. This poses a lot of uncertainties to higher earning individuals. If you are a highly compensated employee and are concerned about this contribution limitation, please reach out to us. We can help you identify the appropriate amount to your 401k contributions in this very uncertain time.
We talked about a Social Security taxable wage base in our last webinar as the maximum compensation that Social Security tax may be levied on. This number is also frequently used in deciding employee compensations. For example, a few slides ago, Amanda mentioned the cash balance plan that she saw. That plan uses this wage base of $137,700 as a threshold. Those who make more than this amount have to mandatorily defer 2% of the excess to the company's pension plan.
The next group of numbers are related to defined contribution plans. Think 401k. For this year, the maximum contribution made to your 401k, you and your employer combined, cannot be more than $57,000, among which you can defer from your pay a maximum of $19,500, and an extra amount of $6,500 is granted to those that are older than 50 years old. This additional amount also increases the defined contribution limit to $63,500 instead of the $57,000.
Some smaller employers might provide simple IRA plans to their employees in lieu of the 401k. $13,500 and $3,000 at the respective deferral limit and catch-up allowance for the simple IRA participant.
Lastly, we have individual retirement accounts, also known as an IRA. We will be addressing IRAs in more details later. For now, remember that one can contribute up to $6,000 into an IRA provided the individual has earned income. The catch-up amount for those age 50 and older is $1,000. Therefore, for those individuals over 50, they can contribute $7,000 instead of $6,000.
We mentioned earlier that traditional IRA is eligible for deduction when income is below a certain threshold. We will take a look at the threshold as listed here.
Depending on filing status, when the tax filer's MAGI falls within these ranges, they start to lose the deduction on their traditional IRA contributions. Note, MAGI, which is Modified Adjusted Gross Income, is adjusted gross income with some of the deductions added back.
An example of this chart would be, let's say, a married couple making MAGI of $150,000. Now the wife creates a traditional IRA account and deposits $6,000 into it. Since their MAGI is above the phase-out range, she will not be able to deduct her contribution, meaning she will be paying income tax on the $6,000, even though she can still contribute the entire $6,000 inside the IRA account and let it grow tax-free.
We will now talk about the tax advantage of a Roth IRA. Unlike a traditional 401k and traditional IRA, the money you contribute to a Roth is after-tax money, which is your pocket money. The amazing feature of a Roth is that you don't have to pay tax when the account is growing, and no taxes are paid when there is a qualified distribution. We will be addressing the definition of a qualified distribution in a moment.
Before we dive into the concept of a qualified distribution, let's first take a look at the income limitation of Roth. This income range is also measured by MAGI. Unlike traditional IRA, if your income is higher than this range, you cannot contribute to Roth IRA, at least not directly.
An example would be a married couple filing separate tax returns. If the MAGI is more than $10,000, a Roth contribution is not allowed. However, another option to consider is a backdoor Roth. A backdoor Roth is where a non-deductible traditional IRA contribution is made and then is converted to a Roth IRA. Since there are no contribution limits for a non-deductible traditional IRA contribution, there is no income limit to do a backdoor Roth contribution. When the non-deductible IRA contribution is made, no tax benefit is received. Therefore, the amount added can be converted to a Roth IRA without incurring tax. This strategy applies if you do not already have a traditional IRA with a tax-deferred funds. Before you proceed with doing a backdoor Roth IRA contribution, it'll be important that you work with someone like us who can walk you through the steps so there's no surprises come tax time.
There's also another option called MEGA, backdoor Roth. This isn't really a Roth IRA, but rather a Roth 401k that has an after-tax component to it. The strategy to contribute to a Roth 401k is considered MEGA since the contribution limit to a 401k is larger than that to a traditional or Roth IRA. MEGA Roth works as follows. You put some of the after-tax money to your Roth 401k. You then do either an in-service rollover, or when you leave your company, you roll these after-tax contribution from your Roth 401k to a Roth, tax-free. The converted amount now can grow tax-free within the Roth, and it is also not subject to required minimum distributions.
IRAs and 401ks are designated to help people save for retirement. The government has an incentive to encourage people to save money. It is achieved through levying a 10% penalty when the money is withdrawn prematurely, in addition to the withdrawals being subject to ordinary income tax. Here is a list of the exceptions that, when met, will enable plan participants to take penalty-free withdrawals.
The first 8 exceptions are shared by both the qualified plan, like a 401k and IRAs. These are things like reaching an age of 59 and a half, faced with permanent disability, or incurred a medical expense that's above 8.5% of your AGI for this year.
Actually, it's 7.5% of your AGI.
Yes, 7.5, yep. Sorry.
There are also individual exceptions that each plan adopts. For example, for qualified plans, if you stop working after age 55, you can start withdrawing from your 401k penalty-free. On the other hand, for an IRA, if you're buying a home for the first time, you can withdraw up to $10,000 from the plan penalty-free. Or if you are unemployed, you can use the earnings from your IRA account to pay for the insurance premium with no penalty. It is important to understand that these exceptions eliminate the penalty. However, the amount withdrawn is still subject to ordinary income tax.
Roth IRA has a slightly different structure from 401k and other IRAs. It uses a concept of a qualified distribution and non-qualified distribution. A qualified distribution is one where the account has been open for 5 years and one of the 4 triggers on the right has been met.
If the account has been opened for less than 5 years, or if none of the 4 qualifications are met, the withdrawal is considered non-qualified and is subject to income tax on the earnings. Since the Roth is funded with after-tax money, the contributions made to the plan can always be withdrawn at any time, penalty-free and income tax-free. That's why so many people use a Roth IRA as a backup savings account.
A Roth conversion involves transferring retirement funds from a traditional IRA or 401k into a Roth account. Conversions are not subject to the $6,000 a year contribution limit. You can convert any amount to Roth as long as you are paying income tax on these conversions. Because you've already paid income tax on these conversion amount, you will not be subject to income tax on them again. But you could face penalties on the amount withdrawn from a converted Roth IRA if the conversion happens within the last 5 years and it doesn't meet any of the 11 exceptions listed here.
A non-qualified distribution from a Roth IRA will subject the earnings to income tax, and you could potentially face a 10% penalty on the earnings if such a withdrawal does not meet any of the 11 exceptions.
We will show you some examples to better explain this Roth taxation and penalty.
So example 1, Mary turned 61 this year. Her Roth account has been opened for 8 years. A large Roth conversion was done 3 years ago. Now she'd like to withdraw from it. So since Mary is over 59 and a half, her account has been open for 5 years. Her distribution is considered qualified. Therefore, the growth withdrawn is not subject to income tax or penalty.
Example 2. Jack turns 45 this year. His Roth account has been open for 8 years. Jack did a large Roth conversion 7 years ago, and now he would like to make some withdrawal. Even though the Roth account is older than 5 years, but because Jack is younger than 59 and a half, is not disabled, and assume he's not using the withdrawal to purchase his first home, this withdrawal is non-qualified. For non-qualified withdrawal, we need to walk through this decision table. Assuming Jack contributed $48,000 of after-tax money into his Roth over 8 years ago, and then the conversion was of $60,000, he can withdraw the $48,000 contribution free of tax and free of penalty. But when it comes to withdrawal of the $60,000 of conversion, it's tax-free. But what about penalty? Since the conversion was done 7 years ago, he qualifies for the conversion exception, so there will be no penalty for the $60,000 conversion withdrawal either. What about the $85,000 of earnings that he made in the Roth accounts over the year? We introduced earlier that all earnings of a non-qualified distribution is subject to income tax. And also, because Jack doesn't meet any of the 11 exceptions, he will have to pay 10% penalty on these earnings if he were to withdraw them.
So example 3, which is our last example. Alex turns 55 this year. His Roth account has been open for 3 years. A large Roth conversion was done 2 years ago. Now he would like to do a withdrawal. Alex's Roth account was open less than 5 years ago, so this withdrawal is non-qualified. Assume Alex contributed $18,000 over the 3 years and converted $60,000 2 years ago. He can always withdraw the $18,000 contribution free of tax and penalty at any time. However, since the $60,000 conversion was made less than 2 years ago, and he doesn't meet any of the 11 exceptions, this conversion will be subject to a 10% penalty. Assuming the account has generated $12,000 of earnings over the years, Alex will be paying 10% penalty on top of the ordinary income tax on the portion of the earnings that are withdrawn.
Companies like to issue stocks to employees for various reasons. In the past, many company matches 401k with company stocks instead of cash. It is growing out of favor now. More and more we see company issue stocks as a restricted stock awards and restricted stock units. Some also issue stock options as incentives. We will take a look at all of them.
An RSU is a restricted stock unit. Typically, for an RSU or restricted stock award without an 83B election, the shares will be granted and the shares vest over a period of time. In such a case, the value of the stocks when it's granted is irrelevant. When the stock vests, the entire fair market value will be subject to ordinary income tax. Once vested, the RSUs or RSAs become shares of stocks and can be sold. At the time of sale, the difference between the stock sale price and its value at vesting will be subject to capital gains tax. If the stock is held for less than a year, it will be subject to short-term capital gains tax, which is equivalent to ordinary income tax rates. If the stock is held for more than 12 months, it will be subject to long-term capital gains tax, which is generally more tax efficient.
RSA with 83B election. For restricted stock awards, the employee has an option to do an 83B election. When elected, the employee pays the ordinary income tax right away at the time of grant. This election carries risk, as the RSA hasn't vested. If the RSA fails to vest or vested at a lower price, the employee will not be able to claim refund on this income tax he paid at the time of grant. However, assume the RSA successfully vested and the employee then sells the stock at a later date. He will be paying capital gains tax on the difference between the stock's sale price to its value at grant. Depends on the duration of his holding, either short-term or long-term capital gain tax rate will be applied. Non-qualified stock options. When granted, these stock options usually carry with them a strike price, meaning the price it will cost you to buy said stock at some future time. The general rule is that the strike price has to be at or above the fair market value of the stock at the date of grant. Options granted with a discounted exercise price will subject you to tax consequences. The stock option usually has an expiration date and maybe a vesting period too. Once the option is vested, you can choose to exercise the option at any time before it expires. However, exercise only when the option strike price is less than the fair market value at the time. Otherwise, it's meaningless, as you can simply buy the stock for cheaper in the open market. Assume in this case, the value of the stock when you exercise is higher than your strike price. You will be paying ordinary income tax for the price difference. After you exercise the stock, you now own this exercise stock option, you now own the shares of your company, which you can later sell. When you sell, you will be paying the capital gains tax on the difference between the sale price and exercise price.
Next, we will take a look at Social Security. Social Security has been around since 1935. It was designated to be a social safety net for our elderly. It is an annuity that is given to the seniors till the end of their lives.
Anyone who has paid Social Security taxes for 40 quarters is eligible for Social Security. The final benefit is calculated using 35 highest adjusted annual earnings. Salaries you made before you turn 60 years old will be adjusted based on an average salary index. But for the years you worked after you turn 60, your salary will be used at face value in the calculation.
Social Security is funded by our payroll taxes that we pay. When there's more benefit being collected from Social Security than the amounts being contributed to Social Security, the fund will run dry. Many countries in the world are facing this issue, and the United States is no different. United States Social Security is projected to be financially insolvent by year 2034. Wharton School of Business estimates it might be sooner, possibly year 2032.
As of now, there are two ways to increase your Social Security benefit. For one, you can delay collecting it. Your benefit increases about 8% each year you delay collecting and stops growing at age 70.
It's always ideal to try to maximize your benefit, as Social Security doesn't pass on to your heirs.
We created a hypothetical work history of a fictional person, let's call him David, and input David's data to the Social Security estimation system. The system estimated the following benefit for David. As we can see in the table, the longer David waits to start his benefit, the more he will receive on a yearly basis.
The graph shows you the break-even points of when David begins receiving his benefit in comparison to how much he receives over his projected lifetime. If David starts collecting his Social Security at age 62, he will have had a head start compared to when he delayed it till his age 70. But if we don't consider time value of money, the absolute value of all of the benefits he collected will hit a break-even point at about year 18 or 19, which is when David is around 80 to 81 years old. In other words, if David lives past 81, it makes sense to delay Social Security benefits on the start date and only begin collecting after he is 70 years old.
The decision of when and how to take your Social Security benefit can be a challenging one that you make. There are pros and cons of taking Social Security early or delaying it, as no one knows exactly how long one can live. The determining factor should be your physical health and your dependency on the cash flow Social Security brings. If you are healthy and you have enough savings to draw cash from, it's a good idea to delay Social Security until you're 70. We work with our clients to help them identify when they may want to begin receiving their Social Security benefit. So if you're in doubt, come to talk to us.
Widowers and widows are entitled to survivor benefits. They can begin collecting the survivor's benefit as early as age 60 while deferring their own benefit, and make a switch to their own benefit when it exceeds the survivor's benefit. With regard to the survivor's benefit, if a widower starts the benefit earlier than his or her full retirement age, the survivor benefit will be reduced. In addition, if the late spouse started collecting Social Security before their full retirement age, when they are still alive, this could also reduce the survivor's benefit for the widower. It will be important to work with a Social Security representative or financial advisor to help identify when a widower should consider collecting benefits. If received early, although the benefit would be collected for a longer period of time, the benefit is reduced.
For those who have divorced, they are entitled to half of former spouse's benefit if the following 4 conditions are all met. Note that remarrying can cause complications such as reduction or suspension of benefit to such divorced spouse.
Next, we'll take a look at insurance products such as life insurance and annuities.
Let's first take a look at the tax aspect of life insurance policies. For one, we pay for insurance premiums out of pocket. It then grows within the product, subject to no tax. This is a tax advantage of life insurance policies, but there is expense associated with this tax advantage that's built into the policy expense. I have seen people buying life insurance within their 401k or IRA, but that might not be the most tax efficient way to do it because you are paying extra expense for tax features already granted to you within plans like 401k and IRA. For life insurance, it accumulates cash value. The cash value will comprise of 2 parts, premium and earnings. Assuming you paid for the policy premiums out of pocket, you can withdraw them subject to no tax. However, you do need to pay ordinary income tax when you attempt to withdraw from the earnings. Amanda, is there a situation where one doesn't have to pay tax on these earnings?
There is. For one, the owner may exchange an existing life insurance policy for a new one or for an annuity free of income taxes. Income tax-free distributions are achieved by withdrawing from the cash value the amount of the premiums paid in, or by using a policy loan. A life insurance policy loan is not taxable as income as long as it doesn't exceed the amount of premiums paid in for the policy. In any case, withdrawals from the cash value may generate income tax liability, reduce the valuable cash value in the plan, reduce the death benefit, or cause the policy to lapse.
There indeed is a risk of policy loans. If you borrow a large amount from your policy and don't pay their interest back, the interest could start to eat away your cash value. Further, if you surrender your policy or your policy lapses, the loan plus interest is considered taxable income by the IRS at your ordinary income tax rate. Sometimes life insurance are being marketed as free from estate tax. That's not really the truth. While the death benefit proceeds are income tax free, they can still be included as part of your estate for estate tax purposes.
An annuity is a common insurance product that is marketed to retirees. Annuities have some advantages. For one, it creates a reliable cash flow that continues until death. It is a contractual obligation of the insurance company to pay a certain amount every month until you pass away. To many people, this is an attractive assurance and gives them the peace of mind. However, this assurance does come at a cost. For this reason, some individuals elect not to purchase an annuity as they may have other sources of annuity-like income. For one, Social Security is a form of annuity, or what we like to refer to as longevity insurance. Some of our clients also have pension plans, which is another form of annuity.
Annuity have some disadvantages too. For one, to purchase an annuity, you have to put down large amount of premium at the onset of the plan. That's a huge setback to your portfolio liquidity. Further, annuity has various forms of fees. One of the larger fees is M&E fee. These pay for insurance guarantees and admin expenses. Investment management fee is charged to assess on investment options in various annuities, and surrender charge apply if you want to terminate your policy and get access to the money. If your annuity contains optional riders, such as death benefit, those benefits may come at an additional cost of rider fee. There is also flat contract fee, even though these can be waived if your annuity is greater than a certain value.
Annuities can be highly complicated. The contracts can be many pages long, some as long as 100 pages. These contracts can be difficult to understand and oftentimes favor the insurance company. Besides the fees and expenses we listed here, the salespeople generally receive high commissions that come straight off the top of your investment savings. Before buying an annuity, it is important to consider other options to manage your retirement income needs in a way that may cost you less.
Right, put it simply, if someone is going to guarantee you an income in an uncertain world, they are going to charge you enough to ensure the odds are in their favor. Annuities can be a suitable product for those who live a long time, don't have other meaningful forms of annuity income, and who don't have emergency cash needs that push them to surrender annuity early. In any case, if you are debating if you should buy an annuity product, come to us and we can help you read through the contracts, do a fair evaluation and impartial calculation to help you with your decision making.
So that concludes part one of our presentation. And now we'll be taking some questions and answers, taking about 5 minutes or so. And it does look like we've actually received some questions. So thank you so much for participating today. We appreciate it. So first, I just want to address, it's been noted that our pace was a little fast in the first section of today's presentation, and we did cover a lot of information. So if there's any specific questions with all the information we've covered, feel free to leave us a private message with your contact information, and we're happy to reach out individually as well as take any questions today, just so we can, help any way we can at everyone's different part of their retirement process. So the first question we got today was in regards to the disadvantages or the differences between a 403B plan compared to a 401k plan. So a 401k plan is generally offered by employers that are a for-profit company, while the 403B plans are offered by companies that are not-for-profits. So they're actually very similar plans. A lot of times they provide the ability to do tax-deferred contributions. The contribution limits that we went over, the $19,500 and then the additional catch-up, those are similar for both plans. So it's not that there's really a disadvantage or major differences between the two plans. It's just has to do with the underlying employer and if they're a for-profit or a not-for-profit company. So thank you so much for your question on that. And the other question is for the 401k to contribute beyond the $19,500 limit. So so everyone has the ability to contribute past that limit once they're age 50. So you can do an additional $6,500. But as far as going past that in your 401k, the max is the $19,500, and then there is the employer and the employee combined match of $57,000. However, you do have the ability to potentially contribute to your own individual retirement account, such as a traditional IRA, if you meet certain income limitations, or even possibly a Roth IRA, even though that's not tax deferred, you would get the benefit of it growing tax-free. And then if there's a qualified withdrawal, you can pull out the funds like in retirement to be able to do that withdrawal. So thank you very much for that question. And another question was in regards to Social Security. So I did mention that Social Security does face insolvency. So my thought on that is, so many of our elderly rely on Social Security. So I think it's going to be, an important thing to address for our federal government to manage the Social Security. I don't see it necessarily going away completely because so many of our elderly rely on it. But I do see that they could potentially increase the age that people can begin collecting Social Security, or possibly even start enforcing additional taxes on it. So when Social Security was first started many, many years ago, our federal government said that they would never tax Social Security. However, most people, about 85% of their Social Security is taxable for most of us. Very few pay no taxes on their Social Security benefits. So we've already kind of seen over a period of time how the federal government has provided Social Security benefits, and then through taxes pulled some of those back. So thank you very much. I appreciate that question. And Shirley, maybe you can help answer this one. The question is, does the Social Security break even point every year include the projection of taking the Social Security benefit early, say at 62, and then investing that benefit?
Yeah, sure. So for the table, the chart we presented, investment was not taken into consideration, and also that's why we said the time value of money was not taken into account. These are just the face value of the amount you withdraw from Social Security, and then added all the years and compare the difference with when you started at 62, for example, versus you start at 70, and then just the face value amount you collected and over the years. That's like how that break-even chart is derived. And then also I'd like to add on to that question Amanda just referred to, that the 401k compensation, the contribution limit of $19,500 limit. So that includes both the Roth portion and the salary deferred, tax deferred portion. So even if you want to do all of them a Roth or all of them tax deferred, is up to you. But then for one, your employer has to allow you to do this like Roth 401k, your plan allows. And then also, even if they do, combined portion cannot be over 19,500 period. So it can't really, because another option, if you already hit a maximum of 19,500, you can do what we call a backdoor Roth if your salary is beyond a phase out period, like the phase out range. You can utilize the $6,000 IRA, since you are not deciding to do like a tax deduction on those anyway. You can just contribute, create a traditional IRA account, put $6,000 in there, don't claim any deduction, and then convert it to a Roth before it generates any income or anything.
Yep.
So then you can do it this way.
Yeah, and there is a little bit of a disclaimer that goes with that, is for some people who have had a previous employment and maybe are no longer working there and have taken their, like their 401k or their 403b contributions and rolled it into a traditional IRA, or what's called a rollover IRA. So when you do the backdoor Roth conversion or contribution, so you're making the non-deductible IRA contribution, and then it actually creates basis in all of your IRA. So when you go to do the Roth conversion, depending on that basis, if you do have some tax deferred IRA, a traditional IRA account, and when you go to convert it, it's actually prorated based on what you had contributed to it on a non-deductible limit. So it's important to work with someone if you decide that you want to consider a backdoor Roth, because for those people who have a traditional IRA and then go to convert it, sometimes they might think that they can convert it, what they contributed as a non-deductible traditional IRA, without having to pay any taxes. And then come tax time, they get a surprise that when they did the conversion, now all of it is tax-free. So some of it might have to be included in income. So there is a little disclosure and disclaimer there. So feel free to reach out to us for some additional questions on that, and we're happy to help.
Cool. Yeah, I see Linda asked a question in the chat box, and whether we're going to have a record session. So yes, we're going to record a session. Like, so we're already in the process of recording it, and then we'll likely upload it to YouTube some point next month. I think like mid-September-ish. And so, let us know your contact information so then we can send you the link when the video is available. Yeah. All right, guys, that concludes our Q&A.
Thank you so much for your participation. Please continue to send us some questions and we'll be happy to address them in our next Q&A section. So as one considers if they are ready to retire, there are several things that should be done to get ready. So in the next section today, we're going to be talking about prioritizing, or are you ready for retire? So we talked about prioritizing a retirement, and next we want to address, are you ready to retire, and help answer that question. And then after each section, section 2 and section 3, we'll be addressing some questions and answers. So feel free to continue sending us those. And as part of our Are You Ready to Retire, we'll be going over a guided checklist. So here is the checklist. So step 1 is to manage your debt as you approach retirement. This is very important because your cash flow is likely to be very different due to the reduced or elimination of earned income. Reducing debt, such as paying off car loans, personal loans, or possibly a mortgage, will help reduce expenses, thus eliminating or reducing the need to utilize retirement savings. Although it is nice being debt-free, sometimes continuing a mortgage into retirement can provide some liquidity that may not otherwise you might not otherwise have. So especially given right now with the mortgage rates being so low, a lot of our retirement folks are considering obtaining a mortgage. So Shirley, so after debt is managed, what's next?
The next items on our list would be checklist item number 2, make a list of all your financial assets. So identifying the types of assets you own and their value can be really helpful, as it can help you to identify the accounts that you can draw from if you need supplemental cash flow. We work with our clients to create a balance sheet and asset allocations so they have a full picture of their financial assets. We also help our clients identify the accounts to draw from and how much to draw in their retirement, taking into consideration the tax implications. After making an inventory of your assets, you may want to think about consolidating them if you have multiple banks and multiple investment accounts. As you approach retirement, you are most likely going to prefer reducing the number of accounts you have, so to reduce the complexity and save your time. You may also want to consider rolling over your 401k. For one, this can help you take advantage of any after-tax contributions you made. In other case, the Roth 401k, which can be rolled into a Roth IRA. For two, this can provide additional investment options, which are typically limited in a 401k plan. It is best to do a direct rollover to avoid any tax implications, and remember to capture the NUA tax treatment if you have company stocks in your 401k. Listing all the assets will give you an idea if your assets is overly concentrated in one bucket. For example, are you house rich and cash poor? Are most of your assets tied to this mansion you own? If that's the case, consider downsizing. In some cases, downsizing your home may be appropriate. This is true if the cost of maintaining the large house, financial or physical, are just too much, and it's more than what you like to pay each month. Selling your house could also help you with the liquidity you need for your retirement. On the other hand, if you have enough liquidity assets and you prefer a large house to host gatherings, then maybe upgrade to a bigger house. After all, real estate in the right area can be a good investment, especially in light of the pleasure you can derive from it. Since we're mentioning real estate, consider liquidating all real estate holdings that are not generating income or enjoyment. Review your life insurance policy as well. As you retire, you may find you have too much or not enough insurance. You may have paid up policies you no longer need and would rather prefer the cash instead. At a minimum, it's a good time to understand what your policies are and the benefits you do have. That's a lot for item number 2. What's next on the list, Amanda?
Well, of course, Shirley, that would be item number 3. Decide on the location where you want to retire. When choosing a retirement location, many people take into consideration the weather. Maybe they're fed up with the cold, snowy weather months in the north. But it's also important to think about if you're really ready for the year-round humidity and heat from Florida. If not, renting a seasonal home for the winter months in the south can be an option too. Besides weather consideration, there are also some other factors you might want to think about, such as income tax, estate tax, as well as property taxes. This map of the United States comes from taxfoundation.org. It shows different states' highest income tax rates in the range of colors from light yellow to deep red, with deep red representing the states with the highest state taxes. Some states have no income taxes that are shown in gray, which include Florida, Texas, Washington, Nevada, Wyoming, Alaska, and South Dakota. These are some of the top states retirees choose to retire to. When our clients are looking to move for employment or retirement, we help them to take into consideration the impact of taxes such as state tax. Although New York is at the top among all the states for average state income taxes, very few New Yorkers are subject to this highest tax bracket. In addition, New York does have a $20,000 per person pension and annuity exclusion, which actually makes New York a friendly state for retirees. Another consideration for where to retire are estate and inheritance taxes. This map comes from nerdwallet.com. As you can see, there are several states that do not have estate or inheritance tax, which are friendly states for retirees. New York is a state that has estate tax but not inheritance tax, as presented as green. For estates in excess of 5.74 million, New York estate tax will not apply. On the contrary, two of our neighbors, PA and New Jersey, have inheritance tax but not estate tax, as represented as blue, while Maryland has both, as represented as yellow. The states that are marked in gray have neither taxes. Understanding the state inheritance and estate tax will help people identify where they want to live in the later years of their lives to avoid taxation. So once you identified a state where you want to spend your retirement years, think about places like big cities or college towns within the state. These are pocket areas that are very convenient with public transportation, groceries, and hospitals all within close vicinity. Retirement communities are also a good option. A relatively new trend among retirement communities is offering 3 levels of care: independence living, assisted living, and skilled nursing, all in a single location, while one flat monthly fee and often an entrance fee. These places give you flexibility and convenience and can be a great value. We also have a client and his wife who sold their house in New York, bought a top-of-the-line RV, and they're spending their retirement lives traveling in the RV. It's all about lifestyle choices. Just before jumping into an RV or retirement, take some time, sit down, and consider all of the factors. Think about retiring abroad too. You can finally use your language skills or pick up some new ones. It depends on where you go. You might be able to enjoy a very low cost of living. They'll stretch your dollars. You don't have to stay there forever either. Just be sure to check on healthcare options and whether your insurance can be used in your new country. That brings us to the next item on our checklist, healthcare.
Healthcare, right. Item number 4 on the checklist is arranging healthcare coverage and draft a living will. So a living will states your wishes regarding life support in the event that you are in a persistent vegetable state or irreversible coma and cannot communicate your wishes. It usually involves power of attorney and healthcare proxy. After your death, the living will can also grant consent to an autopsy, bequest anatomical gifts, and direct disposition of your remains, whether you wish to be buried or cremated, for example. Most other posthumous decisions addressed in the last will and testament that we are going to address in our next chapter. So for now, with regard to your healthcare coverage, you will likely not be able to stay on your former employer's health insurance plan when you retire. If you retire early and you aren't eligible for Medicare yet, you might have to shop at the marketplace. This slide shows you the open enrollment period for Obamacare at the marketplace. Please remember to enroll by the deadline, or you could lose the Obamacare's pre-existing condition protection. Special enrollment period is available if you just went through a life event, such as losing your job. If you're turning 65, you might be eligible for Medicare. This slide shows you the enrollment periods for Medicare. Don't miss the date, as late enrollment could subject you to penalties. We have gone over the Medicare coverage in our earlier webinar on U.S. healthcare system. I will just go over this briefly here. Basically, Medicare has 4 parts, with Part A covering hospital stay, Part B covering doctor service, Part D covering prescribed drugs, and Part C is a commercial plan run by insurance company that combines Part A, B, and D. This is a table that lists the premium, deductible, and co-insurance for Part A, B of Medicare. Consider Medigap insurance if you have concerns about your portion of the cost. Anyway, we went over the details on Medicare about 2 webinars ago titled U.S. Healthcare System. So you're encouraged to watch the replay on YouTube if you'd like to find out more on this topic, or just give us a call or send us an email if you have further questions. All right, after arranging for healthcare coverage and drafting a living will, what's next, Amanda?
Well, that will be item number 5, budget your expenses. It is tedious but important to monitor your spending, especially during the first few years of your retirement. We actually help our clients do a cash flow where we will gather data on their expenses for a full year and categorize these expenses to show clients a picture of how much they are spending and where. A detailed cash flow can help you identify the area to cut back on spending. If your cash flow is tight, are you dining out too much? Or maybe you're spending too much on your grandchildren, or possibly maybe you can do more. After categorizing your day-to-day expenses, you will want to build into your budget any foreseeable future large spending. Is your son or daughter getting married? Does the roof of your house need replacement? Also consider the cost and impact of institutional or home care. Think about whether long-term care insurance is right for you or not. As you consider where to live, recognize you may need a long-term care solution at that place too. Once you've evaluated long-term care options for yourself, think about what happens in case someone else in your family needs long-term care, such as a parent. Can you and will you step in? So now you have taken into account all of your spending and maybe a budget. What's next, Shirley?
That would be item number 6. Calculate the cash flow you needed from your investment portfolio. In the previous step, you have figured out the budget, so you know how much you will need. But remember, if you are pulling the money from a deferred compensation account, you almost always need to withdraw more because you need to pay tax on these withdrawals. Oh, sorry. In other words, you need to think about what's left after paying taxes. The goal is to forecast your net available to spend each year. Having a good idea of the real number is an anxiety reducer. This is why we really love Roth. As Roth IRA, you don't have to pay any taxes when you withdraw if it's qualified. And a dollar is a dollar. If after calculation, you discover that you need to withdraw 10% or higher from your account each year, then your account may not last very long. The historical S&P 500 average annual rate of return is about 9.8%, and that's embracing all the market risk. Just for your reference, it is commonly believed that a more sustainable withdrawal rate is about 4%. On the other hand, if you have large amounts of assets in your ordinary accounts that you don't even need to withdraw any money from a tax-deferred retirement account, once you're 72, make sure you still withdraw at least the minimum from your tax-deferred accounts. This is called Required Minimum Distributions, RMD. If you don't take out the RMD, you're subject to a steep penalty. Retirement is actually the time when some of our clients converted their IRA to a Roth IRA. Granted, they will owe huge tax on that 1 year for this conversion, but they will never have to deal with RMD down the road, and their future withdrawals will not be subject to income tax. Build a cushion into your financial planning. Not everyone is highly disciplined in their spending plans or even their income forecast. If you leave a large enough gap between what you believe you will be able to pull out from your portfolio each year and how much you plan to spend, it will help you reduce your anxiety. It's easier to spend a little more than you planned than less.
So number 7, be psychologically ready. Are you ready for the sudden change in your life? Do you have your support network? A wise client of mine once said that you should retire to do something and not from something. A sudden stop to work can feel like a loss because of no longer having the social interactions at work. always remember that you don't have to 100% stop working. It might be possible that in your field you can work part-time as a consultant. Consider new fields other than the career you retired from, or possibly consider volunteering. It is a time in your life where you can experience doing something different. Look for things in which you set your own hours and you can ramp up your activity up and down depending on your schedule and possibly even the market conditions. Get ready for difficult conversations about money too. In retirement, you'll have to learn to get comfortable with or at least tolerate conversations about money. They're with your children, your spouse, and possibly your dependents, and hopefully your financial advisor. Having these conversations and doing so without displaying your discomfort will make it easier for others to open up about their feelings and wishes too. This in turn gives you the input you need for making those long-term financial decisions.
That's why this brings us to our last item on the checklist. Involve your children and professionals in your financial decisions early. You will discover your children's wishes and they will also see what you're trying to do. Also, after you've kept everyone up to date on all your assets, you need to make sure you tell the information to the people who need to know. Things like where the keys are, especially the keys to your safe deposit box. Make sure those people are authorized to get into the box at a repository. You may also want to introduce your family members to your financial professionals, your lawyers, your insurance agent, so everyone is on the same page about things.
So that completes our second section. So now we'll be taking some questions and answers for about 5 minutes. And then at the last portion of our presentation today, which will be part 3, we'll take as many questions that you guys have. So we did receive some questions. Thank you very much for sending. So the question was regarding insurance, whether it be a whole life or a universal policy. And the question is, what happens to the plan if someone is laid off from their job? Can they keep the plan? So if there is an insurance plan through your employer, sometimes, and it really is dependent on each plan, it might be portable. So what that means is upon you leaving your employment, you can take it with you. So as you purchase or pay premiums on that life insurance, it's important to reach out to your company to see about the portability of your plans, because that should be included in part of your overall financial plan. So another question is, many retired people retire before age 65, which is the Medicare age. And what are they going to do between age, let's say 60 to age 65 for health insurance? So that's actually one of the most key components why people decide to retire, maybe waiting until 65, because the other option is they could pick up health insurance through their spouse. Usually group plans tend to be a lot more flexible in where you can seek healthcare services. You know, a lot of times there's like an out-of-network option, so you can go outside the network that the plan provides. And if that's not an option, the other option is, at least in New York State, there's the marketplace plan. New York State services it themselves, and the federal government also has the marketplace if a state does not provide servicing. So the thing to understand with the marketplace plans is that depending on the type of plan, it can have a very high deductible, still have a pretty high premium that you pay every month, and doesn't always provide the leverage to go out of network. So you might be held hostage to that network. So that is a very good question and important decision in consideration as you approach retirement. Shirley, do you see any other questions that we might want to answer during this section today?
No, I haven't seen any other questions. So if you have, to the audience, if you have any other questions, feel free to send us a text in the chat box, or you can also unmute yourself and ask us. If no further questions, we will move on to the next chapter, the final part of today's presentation. That will be preserving your legacy. So now we have come to the last chapter of today's webinar. We will be going over the 5 common ways to pass your wealth to your loved ones. We estimate this chapter will take about 15 minutes, after which we will be doing our final Q&A, where we will stay for as long as you need us to answer your questions. Now let's start with the first method.
So method 1 is gifting. If your estate is large, it might be good to make gifts now so you can enjoy seeing the outcomes during your lifetime, and also by reducing your taxable estate, if that's applicable. Each person can gift another individual up to $15,000 per year without the need to file a gift tax return. So for gifts that are in excess of $15,000, you will actually be able to use part of your lifetime exemption, which is $11.58 million, which is a federal exemption as of this year. If you are charitably inclined, using a donor advised fund or even a private foundation may be useful. You can take an immediate tax deduction and then advise the fund to make later donations when you have identified what charity you would like the funds to go to.
Method number 2, last will and testament. We introduced the living will earlier. Living will and last will are different things. A living will gives directions regarding the medical care of someone who is still alive but unable to communicate her wishes. A last will directs the distribution of assets after a person's death. Last will is amendable. If properly executed, a new will can revoke earlier wills, be it drafting a new will or add a codicil. You may want to review and make changes each time a major life event happens. For example, if you appointed your best friend as your will executor, but your friend passes away before you, it's time to change the appointment in your will. On a side note, when drafting your will, think through the pet decisions carefully. Many people have specific provisions in their will about their pets, where they provide compensation for the person who adopt the pets after they pass. You all might have heard the story of some millionaire lady leaving behind all her fortunes to the one who adopts her dogs. Well, it can be done in a will. In any case, it's always good to have a will in place, as the probate can be very lengthy if there isn't any will. Speaking of probate, Amanda here has extensive experience helping clients and clients' family members with probate matters. She can be of a good resource for you if you or your family member have questions about probate.
So method number 3 is naming the beneficiary you care about on your retirement plan. It is important for everyone to check to be sure they have an individual listed as beneficiary on their retirement plans, and in some cases, a trust. If a beneficiary is not listed, or if you name the beneficiary as payable to my estate, it will be paid to your estate, which could have a negative tax consequence and result in the unintended probate process. When it comes to a 401k plan or 403b plan, a spouse must be listed as beneficiary of the plan, unless they specifically sign off. If you name a non-spouse as your beneficiary, the 401k plans generally allow for a non-spouse beneficiary where they can roll over the account to an inherited 401k to an inherited IRA. They might even be able to capture the NUA tax treatment too if the plan has company stock. Spousal beneficiaries of an IRA have the option to take the account and manage it as if it were their own, so they won't be subject to the RMDs. However, a non-spouse beneficiary are subject to the new Secure Act, which eliminates the ability to stretch the distributions over the beneficiary's lifetime. New this year is the 10-year rule, where a non-spouse beneficiary inherits a retirement account where they must make the distribution by the 10th year. This changes fast tracks the withdrawals, and as a result of that, will also include a higher taxes being paid on the account. There's also a 5-year rule also, so putting that out there as a disclaimer.
Method number 4, beneficiary of insurance product. Adding someone as beneficiary as your life insurance policy can be the 4th method of passing wealth to someone you care about. Said beneficiary will receive the death benefit free from income tax. Beware, however, this death benefit will still be counted as your estate tax, as your estate. And if your estate is over the exemption amount, these death benefit proceeds can still be subject to estate tax. Cash value is usually available in permanent life policies, such as whole life. Cash account within the insurance builds value. When the insured is still alive, the owner of the policy can borrow against the cash value, withdraw money from it, or even use the cash value to pay policy premiums. However, cash value is forfeited when the insured passes away, unless a rider stipulating otherwise is purchased.
So method number 5, which are trusts. So the last method on the list is the trust, which a trust is a legal vehicle that allows a third party, which is a trustee, to hold and direct assets in the trust fund on behalf of a beneficiary. One major advantage of a trust is that it avoids the probate process. Trusts generally fall under 2 large categories, which are revocable trust and irrevocable trusts. You can amend or cancel a revocable trust. Such a trust is highly flexible and it can be used to generate income to the living grantor. An irrevocable trust is a permanent trust. Once you transfer your assets to an irrevocable trust, you hand over all of your ownership. In other words, the assets are no longer yours. These trusts are often used to remove assets from one estate, provide protection against creditors, and possibly protect against the assets from divorce. If the trust assets generate income and distribution is done, the trust will issue a tax form called a K-1 statement to the beneficiaries who receive this income, who then must report it on their income tax returns. The trust then pays tax on any undistributable income, generally at higher tax rates than the individual would pay. So that concludes our final section today, and we're taking any questions and answers, and we'll stay on as long as you guys would like. So feel free to send us your questions in the chat feature of this webinar.
Amanda, I think we received a question about one audience is curious for our clients who bought an RV and then just driving the RV without settling down in any particular state. What kind of state tax will these people be subject to?
Well, that is a really good question, and I would highly encourage someone to work with a tax professional on that. So a lot of times it has to come down to where their residency status is that they elect, and it could be maybe a mailing address. Also taken into consideration is how many nights they sleep in each state. And for most people, if it's more than 183 nights, then you're classified as a resident of that state and required to file a tax return. So I would strongly encourage that you work with a tax professional to take a look at your particular situation to see if you are required to file a tax return with any particular state.
Right. So for especially you need to keep track of your itinerary. If you spend like for the state of New York, I heard, even if you were just here briefly for a meal during the day, that counts as a day. And so there are other states who are even more strict about it. It's like they even test your intent. Do you ever intend to treat this as a domicile? Do you want to, is this the place you will go to? If anything happens, you want to get medical treatment. And so like they take into all these into consideration. So it's very common for people to just point one of the states, like for example, Florida, where you just like no income tax, like just name that as your state, as your home state while you're traveling. And so, but just keep track of all the other states' rules, such as New York, the 183 days rule. And so, and then keep track of where you are every day. That's, something to keep you busy.
Yeah, and another good thing to understand is if you own a property, like a real estate property, a home, that actually plays in pretty heavily to, that state most likely will be your state of residency. So understanding, all of those rules and working with a tax professional is a great thing to do. So great question. Thank you very much.
Yeah, and then a company like ours, we have a tax department with many people working there as CPAs. And then Amanda and I, we help our clients filing taxes. And so like any tax specific questions and, or you'd like someone else to lay a second set of eyes on your return, we can help you review it and just, let us know, give us a call. Any other questions that people may have?
No, I don't think there are any further questions. So thank you all so much for participating today. And it's really hard to believe that we started our first webinar on investments in mid-May, right after the March crash and April rally in the stock market, which is a nerve-wracking time.
I know.
The market was literally going through a roller coaster ride. People were panicking. Should I sell? What should I do? Well, overall, I think that webinar was pretty timely. We had about 40 audience join us during our live broadcast that day. And since posting the replay online, we gathered maybe 60 views on YouTube and a few thumbs up too. Nothing makes us happier than seeing our audience armed with better knowledge about finances after attending our series.
So true. That investment webinar was a success. We subsequently did one on healthcare in June. Oh, sorry. We subsequently did a healthcare in June where we walked through the milestones in recent history of U.S. healthcare policy development, as well as introduced various forms of healthcare insurance, particularly Medicare and Medicaid. We also did an in-depth discussion on how the long-term care issues work.
Yeah, and following the healthcare webinar, we did another webinar on taxation last month called Tax 101. In this webinar, we listed all of the taxes that an individual is facing in the United States, walked through elements of the income tax formula, as well as estate and gift taxes and how they affect non-resident aliens and non-dissimilary. All three webinars are highly relevant to what we talked about today on retirement.
Absolutely. See, even though we break up the financial topics into 4 sessions, they really go hand in hand. Your investment decisions could impact your tax liabilities. Your healthcare decision could significantly affect your health, your wealth, and all of them are key factors affecting the quality of your retirement life.
If you have seen the previous webinars, great. If not, we strongly recommend you watch the replays after today's webinar. We will be providing a survey to everyone, as well as a link to our webinar replays.
Right, and then after today's webinar, we'll be working on turning this into a video and uploading it to YouTube and make it available sometime in September. And then for those of you who are CCA members, you will likely receive an email sending you the links to our last webinar, and then you can also send us an email, give us a call, and we can send you the direct links as soon as available. And thank you all so much for joining us today and for all the past webinars. Let me turn on my webcam. So yeah, let me see if I can. Yeah, I can. So any of you, if you can turn on your webcam too, we'd like to see you. I mean, some of you might have been on the show for all the 4 webinars. We're so grateful for your participation. Yes.
Yeah, and we do have a question, Shirley, if you want to take a look.
Yeah.
Yeah.
Is it in the chat box? Okay.
Yes.
Oh, so sweet. Thank you. Is that Jun, are you on? Yang Jun, it's yes. Oh, thank you, so much for giving us this opportunity to do these webinars and helping us promoting these webinars to the CCA members. We're so grateful.
Yeah, I think it's very helpful. I hope our members kind of learn something, and kind of I believe this is kind of still like a start, and if they have kind of further engagement, there is kind of opportunity.
Yeah. So just as when we did the webinar on text, things are changing like on a daily basis. There's the bulletin that's being published every week. There's always constant changes. The Secure Act, for example, made a lot of change for the tax rules. And then we also see, the IRA rule is changing every year. And so that's, especially with the current economy condition, you can see, you only see more changes coming. And so it is, always, like a professional like us, we stay on top of all those changes. And so I do see maybe next year or so, we can do another webinar on just updating members on all the changes. And in the meantime, if you have any questions, just reach out to us.
So Shirley, there was a question, and the question is, there are insurance products claiming tax benefits by offering investment options. That was the question.
Sorry, is it? Oh, okay, I see the question now.
Yeah, and it says, but if the insurance payout counts to one's estate and cash value is forfeited upon death, are there any real value in those type of products?
Well, that's a really good question. So that can also be the product specific. You see for a lot of the product, they have really long contract. So it's embedded in there. What is really, who can claim the death benefit? The rider is an option. Rider is just additional clause put in there. So even though this is how the rule goes, and now here's a rider that you can actually get it, your beneficiary can get it. So there's really no, universal rule how it's applied, because, generally the cash value is forfeited, and then the insurance company will absorb all those money. But if you paid for a rider, or maybe this policy is just more generous than others, and it could have a stipulated other way. So you just, if you have a policy there already, if you have a question, bring it over, we can take a look. We help people review insurance contracts all the time.
Yeah, and in fact, on one of the estate probates I'm working on, if you list your estate as beneficiary of your life insurance policy, it is included in your probate and included in your estate. So naming a beneficiary can really impact if it's includable and not in your estate. So for people who list a beneficiary to maybe another person, they might be able to avoid that being included in their estate, and they could subsequently pass on that life insurance death benefit free of tax. So it's so important to work with someone, whether it be, a financial professional like us, or maybe your attorney, to make sure that the structure of your life insurance is avoiding being included in your estate, and that there is a beneficiary listed, most often an individual or maybe a trust that could be eligible to look through to the beneficiary. So all those things are so important in the estate planning process.
Yes.
Yep. So there could be
Okay.
some value as far as liquidity for an estate. So there is some value to having life insurance. And I always encourage my clients to look at the reason why they have the insurance, because sometimes over time, the reason could change. You know, maybe they picked up a term policy to help, you know, pay for a mortgage in the event something might happen to a spouse, or maybe they picked up a whole life policy and they're now retired and they don't need that income replacement. So sometimes those policies don't necessarily serve their original purpose. And at that point, they can consider looking to see if it makes sense to cash it out, maybe continue it. It is something important to review, because once you do cash out and liquidate the policy, then it's gone forever. And if something were to happen the following day to someone, you would lose the opportunity of collecting that death benefit.
Right. And then as someone age, the cost of insurance always go up. So, you know, like if you cancels your life insurance, even though it can be expensive, but then you might not even be able to get another one. You know, like if you, even if you were thinking about getting a term life policy, and you just like the premium can be really high. And same with the long-term care insurance, that premium just keeps going up every year. And if you guys watched a webinar we did 2 webinars ago on the US healthcare system, in the last chapter we talk about long-term care. So that insurance is just within like 20 years or so, it's like more than doubled. And then it's just crazy how much those insurance premiums can gone up. But if you, and then fewer insurance company offering those now, it's just it's not really profitable.
Mm-hmm. Mm-hmm. Yep, and there are other alternatives to look into, like a life insurance policy that might have a rider to pay out for long-term care purposes.
Right.
And a lot of times those type of products are less costly, but it's important to look at all the details and, you know, the thick packet that might come with it to make sure it sufficiently ties into the purpose that you're looking to fulfill. Right. Mm-hmm.
Yeah, like a lot of the types of products can be a suitable products, and then the key information is whether you understand what you're buying into. And so so like if you find the description of the policy is too lengthy to digest, and just give us a ring and we can help you take a look.
Mm-hmm.
All right, any further questions? I don't see any. And then thank you so much, guys. I recognize some of the familiar names that has been here for, like, you know, all 4 webinars. Like you're our star. Thank you.
Thank you so much.
We're the fan. Yeah. Thank you so much for participating. And this will be the last webinar for this series, but, you know, don't be a stranger. CCA hosts events every year. I mean, now due to COVID, you guys probably don't get to, you know, like we don't get to meet in person, but we can always have virtual meetings. And, you know, hopefully when the COVID phase pass, and then we can, you know, like get back together. I look forward to participating in all the gatherings, and yeah, I'll see you around.
Yeah, maybe someday we'll see each other. That'd be great.
Yeah. All right,
well,
guys.
have a wonderful rest of your weekend. Take care, everyone.
Thank you. Thank you, guys.
Thank you.
Bye.